Thank you everyone for joining us today. Excited about our topic and talking about donations. I'm Beth Farley and I am out of the Reno, Nevada office. I concentrate most of my work on audits and outsourced accounting services. And I mostly work with nonprofits. That's a big area of my practice area, and I am just so excited to be able to talk to nonprofits and educate you guys about what's going on in accounting. So I'm glad to be here. Later on, Anne will be presenting on some of the subjects as well, and she's the manager in our Fargo, North Dakota office. She focuses on tax and outsourced accounting services. So you've got a couple different perspectives here. We hope we can provide some great information for you. Today we have a couple of learning topics, subtopics of revenue. So first we're going to start and talk about contributions and promises to give, how to define and find the differences between those, looking at restricted contributions and releases from restrictions, how to track those, the best practices, understanding in-kind contributions, and then finally going over donor reporting requirements. So let's jump right into contributions and promises to give. I always think it's a really good idea to start with your generally accepted accounting principles definition. It's always a great place because that's kind of the standard we're going by. And I think what's important too is for us, is for nonprofits to really evaluate what is considered under 605. That's kind of the revenue standard that we're looking at for contributions. I'm sure many of you have talked about or heard about 606 or revenue recognition standards that changed in the last couple of years. And so just defining what falls under 605 and 606 will help make sure that you're recognizing revenue under the different standards properly. So if you look at that kind of highlighted portion there, the definition is an unconditional transfer of cash, assets, whatever that looks like, that is voluntary and non-reciprocal. So that means it's voluntary, it's not required from your donor, and it's non-reciprocal. They're not receiving something in exchange for that. So kind of keep that in mind as we go through the rest of the slides here. So as we dig a little deeper into contributions, contributions are non-exchange. They are cash, promises to give, investments, property. There's a lot of different ways that you can receive that non-exchange transaction. So it's not necessarily just the donation check or cash that you get in the mail. Just keep in mind that you want to evaluate these standards for all types of transactions that you do receive. Secondly, we're looking at conditional contributions. Those are contributions that are received if both of the following are met: a right of return and a release, release must exist, and then the agreement must include a barrier that the recipient must overcome. And that barrier both of those should be expressly stated from the donor themselves. And then once those conditions are met, then we're going to be recognizing that contribution. This step in determining if it's conditional contribution can take some detailed reading of your agreements and supporting documentation that you receive from your donor, which can include a variety of different forms. And we'll go over a couple of those later on, but it may be the original contribution request that you fill out for a foundation or whatever that is, and then also the letters that you get back, the conversations that you have with them. So make sure that you're documenting all of that. I like this graphic here because I think it really just kind of drives in the point that I was just mentioning, is that a donor imposed condition has to have both of these things. The right of return or release from the donor's obligation must be determined from the agreement or another document referenced in the agreement. So maybe sometimes it'll reference something else, but it must be defined in there. Then the barrier has to be something that is going to be overcome. In the next slide, we'll talk a little bit more about the barrier. A lot of foundations do contain some of this wording. Some of them contain wording about the right of return, and some do not include that. That's why it's very important to make sure that you are tracking those, particularly between them. So let's look at what indicators there might be that a barrier actually exists. So the first one is going to be the inclusion of a measurable performance-related barrier or other measurable barrier. So measurable is really important here, that it is not necessarily just a report that you're going to send at the end of the year that says, yeah, we served X number of clients, thank you for the funds. It's something that you actually have to measure and notify the donor about. A stipulation should be related to the purpose of the agreement. So if they provide you a barrier that maybe isn't unrelated, that would be a discussion for sure. And then the extent to which a stipulation limits discretion by the nonprofit organization or over the conduct of the activity. So these are indicators of barriers. It's not necessarily, like I said, a simple thing. It is something that must be overcome by the organization. So let's talk about, you've gone through the process, and that's the important piece. You've gone through the process. Are these conditional? Are these unconditional? And then once you have documented that and made those decisions, then you can dig into how to record them. The first thing is unconditional contributions are recorded when the unconditional promise is made or is received, or the amount is received. If a condition exists, then it will impact when the contribution is recognized. It may not be recognized right away. So a couple of examples here is unconditional. Somebody says, I'm going to give you $100,000. You're going to recognize that revenue at the time the promise is made, even if it won't be received right away. In that recognition, you're going to journal entry to record as a debit to promise to give and a credit to the contribution receivable. We'll talk a little bit later about what's the difference between intent and promise, but keep that in mind for us to go that. But if it's unconditional, you're going to record it right away. Conditional is somebody says, I'm going to give you 100,000 if you can raise another 100,000. In this example, they won't give you anything unless you receive that full 100,000. So you're not going to record that as revenue until the barrier, raising the $100,000, is overcome. There will be a disclosure in the financial statements if you do cross fiscal years, and no journal entry would be recorded until that condition is met. Once it is, then you're going to make a journal entry to record the receivable or cash if you got it at that time and a contribution revenue. If, however, they give you the $100,000 and it's conditional, because if you do not raise it, it will have to be returned, then you would record it as a journal entry to debit refundable or credit refundable advance and debit cash. And then once you meet that condition, then you're going to debit the refundable receivable, and at that point recognize the contribution revenue by crediting that.
Hey, Beth, I'm going to interject really quick here. Just we did get a question regarding an example of a right of return. And so that was part of our conditional piece, is that we have the barriers and then a right of return. Do you have a kind of quick, easy example on a right of return? Or
a right of return would be something that is stated from the donor that says, if these funds are not spent in accordance of that, then we would request that you return those funds to us. Instead of you maintaining them. There are sometimes agreements where it says, if you don't send them in accordance with this agreement, then maybe you can spend them on something else, and that that a nonprofit would spend them on. Or if you close as a nonprofit, then you can send them to another nonprofit that's doing similar things. So there may be some wording that does not specifically state you have to return it to us. And the important part in that is that it should be documented, not just, I think most of us would assume that a donor wants the funds back if we do not spend it in accordance, and that might be a conversation. But if it's not documented somewhere in there, that's the important piece, that it's actually the right of return is actually documented and communicated from the donor. It's a great question, because I think that does come up. What does that look like?
Yeah, thanks, Beth.
Yeah. So some of the documentation that you want to make sure that you have sufficient evidence for why you're recording it as either conditional or unconditional. Here are some examples that you would look at. to make sure that you're recording these appropriately. Obviously the name of the nonprofit and the donor to make sure you're identifying the parties, description of what's to be contributed. An example here would be like the in-kind service, maybe the stock that you're actually being donated if it's something other than cash. I'm not going to go through all of these. Another important one would be the dates. If it is a promise to give, make sure that the expected payment dates in the future years is documented on there. On the one in kind of the middle of the screen, when we're talking about irrevocable, making sure that the donor has stated that it is unconditional and irrevocable. Examples of these kinds of a donation documents would be a signed pledge card or agreement, copy of the check that shows the restriction in the memo line, letter from the donor. A memo documentation of a phone call could work for that, but you would want to make sure you include all the information we're kind of stating here, names, the date of the phone call, and the discussion. I do say that it's better to have it in writing. So if you do have a conversation with a donor, if they can put that in writing somehow for you, then that is the best practice. But if they are not able to or would prefer not to, then, you know, documenting very well who you spoke to and when would be important. The thank you letter back to the donor can also constitute supporting documentation, stating the dollar, the description, and then also, you know, any other information about the restriction or the purpose of it would be important too, so that you're clearly showing what the intent of the donor had asked for. So let's talk about promise versus intent. This comes into play if you do have a promise to give when that gets recorded. A promise will indicate an unconditional promise to give them that is legally enforceable. And then that's when it's going to be recorded as a contribution. There are a lot of times that nonprofits do receive an intent versus a promise. If somebody calls you up and says, I really want to give you this money, I'm just looking at how much it's going to be because I'm waiting on a couple of things to fall through, that's just an intent. Until it's legally enforceable, you would not record that. Intentions do not result in any recognition at the time. So let's talk a little bit about how promises to give are recorded on multi-year. So this would be a promise to give. You've identified that it is something that you're going to record because it is, there's an actual promise there, not just the intent, and it's over multiple years. So first, you're going to record the unconditional promises made, kind of as we talked about with those debits and credits previously. A couple things to keep in mind here that is not always considered, and we want to make sure we are, is that there's a discount to the present value of cash flows, meaning that if somebody gives you $100,000 and they're going to give you $20,000 a year for the next 5 years, in 5 years from now, that $20,000 is not the same value that it is today. So there should be a discount on those cash flows that's being calculated. And there's some methodology to do that. You can utilize an Excel formula or some other method for that, but you do want to make sure you're doing that to see that if that becomes a material amount. Secondly, you have allowance for the risk associated with non-payment. What we see with promises to give, a lot of times the first year or two, you have most donors providing full payment that they had planned to do. So if you have somebody who did donate that $100,000 then you get the first $20,000, there's a risk that by the third, fourth, fifth payment, one of those, maybe that donor is unable to or is not wanting to provide that payment. So you have to evaluate that risk associated with how many donors will not pay the full amount of the promise to give that they gave you. If this is the first time you've ever done a promise to give, it takes a little bit more work to get there. If you've done promises to give in the past, then you would look at historically what that looks like for you. But you can also look at other nonprofits and what they're using that are similar to you in the area or in other areas as well. So you will have to do a little research on that area. Remembering along, of course, an intention to give is not recordable. So if it is an intention, then you would not have to walk through the discount and the allowance. These can be time consuming. So if you do plan to do a pledge drive, really consider all of these things as you're doing that so that you make sure that you set aside time for the accounting piece as well. So recording the promise to give, once you receive that promise, you're going to debit promise to give, and you're going to credit contribution revenue. If the promise to give is a multi-year, you're going to do that calculation that we said, and you're going to debit contribution revenue to reduce that and credit a contra promise to give receivable account, so that you're tracking those separately and keeping track of both the discount as well as the allowance. All right, so there's a lot that we kind of went through with promises to give and contributions, but then the next step that we're going to look at is restrictions. So let's talk about restrictions versus conditions. A donor-imposed restriction places limits on the use of the funds to the organization, and it can affect the ability of the nonprofit to provide services if they do have donor-imposed restrictions that are large in one area and not enough in another area that you're trying to provide services. So it is important that you evaluate that as you are bringing in donor-imposed restrictions. Donor-imposed conditions, like we talked about, must have both the barrier and the right of return. So you could have a restricted item that does not meet a condition, but it is restricted. All right, so let's talk about restrictions specifically. So they have to be imposed by the donor. A lot of times I'll hear organizations talk about restricted, that the board had set aside funds and they call them restricted. I think it's good to get used to the terminology in the nonprofit world that restrictions are from the donor only. So you're going to record those as net assets with donor restrictions. You're going to see that on your statement of activities and statement of financial position that way. And those restrictions can be either temporary in nature or perpetual in nature. Temporary in nature, it means that your restriction from the donor is either a purpose restriction or a time restriction. So an example of a purpose restriction would be for scholarships or for a capital campaign, specific faculty or employee support that you're being provided. Time would be maybe a multi-year pledge, a beneficial interest in a trust, something like that. Perpetual in nature is going to be an endowment, an item that's held in perpetuity for the organization, meaning that you received a donation, that's going to be held. Usually the earnings are used for a specific purpose or over a specific time. So sometimes that will be split between the two if you do receive an endowment. And it is important that you're tracking that separately as the earnings come through on a perpetual donation, that you want to make sure that you're tracking how that came in, as the temporary nature of it, how that's being spent, so that you have all that information to properly report internally and externally. The next piece that we're going to go through is this board designated. So these would be anything that's recorded as net assets without donor restrictions. And those fall into two different categories: amounts designated for operating or capital reserves. If a nonprofit wants to set aside reserves for, say, just operating general, it's usually a good idea to have several months worth of operating expenses set aside as a reserve for just cash flow issues and concerns potentially. And so those would be set aside for that, and they would normally be just a set dollar amount, say $100,000, and it's going to show up in your financial statements, but not necessarily would you see earnings increase that, and those would be changed by the board of directors as they decide to reserve more or utilize them if something occurs. The other kind would be amounts designated to be treated as an endowment. This would be treated very similarly to a donor restricted endowment, in that there's something that's set aside that the board wants to see kind of grow. They're going to use the earnings for specific purposes. My biggest recommendation in board designated amounts is to be very clear in your documentation. Sometimes an organization will have an amount that was set aside by a board members have changed, it's been about 15 years, nobody's really sure what that original intent was or what the discussions were. So if you decide to set up board designated amounts, make sure that you are disclosing how much it is, why you're doing that, what purposes it should be spent on, how it should be invested if it's an endowment, what those earnings would be spent on, and very clearly walk through all of those items. Once you have shown your contribution as either as restricted, then you're going to have to show what's been released. So as you utilize those on the expenses, then you want to track exactly what expenses are being shown to reduce that restriction. They can be, of course, released by either fulfilling the purpose restriction or the time restriction when that's passed. Some restrictions may have both. So there's a potential that there is something that you receive that's a time restriction, but it also has to be for a specific purpose to support as one of your programs. So you may have to make sure you're meeting both of those as well before the release. There are two different accounting policies that an organization can adopt regarding the releases from restrictions and how they're shown on your financial statements. And I'm going to show you disclosures on the next slide just so you can see how those show up. But it's important to make sure that you understand how those will, and that's whether or not you're showing restricted that have been fully spent in the same fiscal year as restricted or not. So tracking that will be important. And then I do want to really highlight this last bullet here is that restricted funds have to be spent first. If you have some internal funds that you've set aside for a capital project, but you're also receiving donations for a capital project, you want to be showing that you're spending those restricted funds first. It benefits the organization as well, because if you have an excess of funds, hopefully everybody wants an excess of funds, that you can redesignate any internal to another project as seen fit, but restricted funds should be spent first. So here's those two disclosures that I was talking about, and I've highlighted kind of the section down below that shows really what you're looking at is that the first one states that if a donation comes in, so you get $100,000 and you spend the $100,000 in the same fiscal year, then in the first example, first disclosure, you would show that $100,000 as contributions from donors with restrictions and as a release from the restriction. In the second one, if it's met within the same time period, you would show it as contributions without donor restrictions, and those expenses you'd see no release. And so that's why I'm saying it's important to understand how your organization has chosen to present those in your financial statements, because you need to gather that information to make sure that the financials are properly reporting the contributions with or without donors, and then also the release from restrictions. So if you're not sure, make sure that you've kind of done a little digging, look at your financials and go through that and make sure that you're tracking that properly. Recording on restricted contributions. So a couple of different things we just want to talk through and give some examples. First and foremost, always try to do that within your accounting system. That is going to give you the most information with reports that you can pull out, and you're not having to try to tie back into that. So if you have an accounting system that allows you to do that, then that would be your first place to go. QuickBooks Desktop, QuickBooks Online, there's a way to do that with classes, jobs, tags, there's a lot of different things. So make sure you're kind of evaluating that. Secondly, if you are utilizing Excel, maybe it makes more sense for your organization to do that for a variety of reasons. Really make sure you're tying that Excel file back to your accounting system. Total contributions for the year should match. Releases, you should be able to figure out where those come from and make sure that those are tying back into, and then your net assets, of course, are tying to the statement of financial position. So do a double check on that as you're going through closing out. Tracking should always include the name of the grant, the amount, the date received, conditions, what that is, a right, a return, and barrier, and then your restriction, your purpose and timing, and how it was utilized, what expenses were incurred to reduce and show that release. And make sure that you're doing through this as you go throughout the year. Try to gather this at the end of the year, because that can make it very difficult to try to figure out what your year-end balances should be. You know, that's a lot of information. There's a lot of things to keep, but hopefully that just kind of keys you in on making sure. And documentation, I probably said a lot of times, but that's always my biggest thing. Make sure you're documenting and you have the support for how you recorded it and when and why. All right, we're going to jump into in-kind donations. Anne's really going to take over here. I'm just going to pop into the first slide here in in-kind contributions, that there is a new standard that is that you want to consider and make sure that you're documenting and going through what those new requirements are. There's not really changes on how you record and what you record as in-kind contributions. The presentation requires a separate line on your statement of activities. However, the disclosures, there is more disclosures, qualitative information about whether or not you monetize that. If you have what your policy is, if you have one about monetizing, meaning that you sell instead of utilizing any non-contributed non-financial assets, what donor imposed restrictions there were, what valuation techniques you used, and the principal market that you utilized to arrive at that. These are things that you don't want to try to figure out once your year has closed and you're preparing for your audit. You want to make sure that you're gathering this information throughout the year, each time that you do receive a non-financial asset contributed to the organization. And with that, I'm going to let Anne go ahead and jump in.
All right, thank you, Beth. So I have our next slide here to kind of go through a little bit of what are we talking about regarding gifts in kind. And looking at this is something where those gift in kind contributions, it's a pretty broad term, and it just means, any gift that is a non-cash gift. So this could include tangible property, such as furniture, equipment, clothing, supplies, any fundraising materials, informational materials, collection items. It could also include intangible properties. And these are things like if you have a loan that you receive, but there's no interest being charged on that loan, that interest would be an intangible item. Contributed services are a big one that we usually see. Contributed utilities, the use of long-lived assets, advertising, including media time or media space. And really, these gifts in kind are recognized at fair value. So what are some common issues that we have with gifts in kind? Really comes down to, when should these be recorded? How should they be valued? And what's the reliability of the information? We'll go into this a little bit more in detail here. And so looking at, why are we recognizing in-kind contributions? It really is something where we should be recognizing these if we have discretion in using or distributing, the item. It is something where our organization, if we have the risks and rewards of ownership, we really should be recording those as well. If it's a specialized skill that's being provided, those are recorded as well. And why do we recognize them? Well, it provides a better information about our support and our costs. It allows for comparability between similar organizations that may have different sources of support. And these in-kind contributions could also impact reporting for federal and state requirements. There may be some reporting levels based on revenue where if you're missing your in-kind contributions, you really are understating your revenue and you may be completing the incorrect documentation for federal and state regulations. And in certain circumstances, they are also required by generally accepted accounting principles. So I have an example here, and we have the ABC organization. If they were to run a backpack program and they get $3,000 in supplies from the XYZ company, pretty easy on their side as far as being able to value it. They can look and see what the cost is on those items and go in and get that information, record that $3,000 as the value of the donated items. And then they also report that in-kind supply expense of $3,000. Now our organization shows that they received these supplies. What if they had instead fundraised for this money? They would have $3,000 in cash that comes in. They would have someone go out and purchase, and they would have $3,000 in expenses. And you have two very similar activities by the organizations. So if our organization, the ABC organization, hadn't recognized our in-kind donation, those donated items to them, really, they would not have any revenue And since they're not going out and purchasing those supplies, they wouldn't have any expenses. And the organization that actually received the cash, purchased the supplies, appears on paper to have a higher value in revenue that they received, even though the two organizations would be very similar. So let's talk about contributed services. So for financial reporting purposes, this is something that in general, if any of the following criteria are met, if the service creates or enhance a non-financial asset, if a specialized skill is required and provided by individuals possessing those specialized skills, and if it's something that the organization would typically need to purchase if it wasn't provided by a donation. These transactions are typically reported for financial purposes as revenue and recognized. And then an asset is recognized and an expense is also, you need to decide really if an asset is recognized, if it's a long-lived asset, or if it's something where it's being used within the same year, you would expense it. So you'd have the in-kind contribution, and then the debit would be the expense or the asset. That recognition is not affected by whether the nonprofit could afford to purchase the service at their fair market value. And it is worth noting too, though, that the treatment on the IRS side is different. So for IRS purposes, any contributions of services or the donated use of materials, equipment, or facilities, these are not reportable on the Form 990. So I have another example here for services. We have the XYZ Construction Company. They've been selected to serve as the construction manager for ABC Organization's upcoming project. And this is something where they agreed to provide a 30% discount on their services, which is $30,000 or $300,000. The board approved the contract and it's been signed by all parties. So we can recognize this transaction. So for financial accounting purposes, we do report the contributed services once those conditions are met and the services are provided and the conditions are met. That full $300,000 will be recorded. The journal entry would debit either the PP&E or the in-kind expense, depending upon if that project's being capitalized. And then the credit would be for the in-kind contribution revenue. For tax purposes, the revenue from the contributed services is not included on the Form 990. And depending upon if the project is capitalized or not, the expense would not be included on the Form 990. And so you would have, if you are an audit, if you are completing the Schedule D, the Form 990 Schedule D would have a reconciling item to eliminate both the in-kind contribution and an in-kind expense. If the project's being capitalized, then the Form 990 would have an adjustment to net assets to account for the non-recognition of the revenue and expenses. So contributed property and equipment such as long-lived assets in which the donor retains legal title to the long-lived asset. This is something that for financial reporting, these are recognized at fair value of the use of the property. The use of the property, or if it's a utility or contribution revenue for the period in which the contribution is received, and the expense is recognized in the period that the utility or the long-lived asset is used. For financial reporting purposes, there are additional requirements for recognizing services. Those ones in these particular situations for the use of long-lived assets or the use of utilities are not required to be met for the more traditional service requirement. For IRS purposes, these contributions, since it's for the use of the asset or the utility piece. It is something that our organization, if the recipient organization is not retaining the rights and ownership of those properties, then it's something that those transactions would be eliminated for IRS purposes. Donated media and advertising are reported similarly. So for financial reporting purposes, these would be recorded as a contribution when the non-financial assets are used for the nonprofit's benefit, or if they're provided at no charge. Encourage the public to contribute to the nonprofit or help the nonprofit communicates its message or mission. And the not-for-profit has an active involvement in determining and managing the message and the use of the materials. So these in-kind donations are measured at fair market value, and an in-kind contribution expense and in-kind contribution revenue would be recorded. Depending on the not-for-profit's involvement, this really can become a subjective determination. So it gets to be a little tricky to determine these pieces and to value them. For IRS reporting purposes, the donated media and advertising time are considered services, and these would result in those elimination on the Schedule D if that's required for the Form 990. I have on here, next slide, I have some examples of some of these activities. So really we're looking at, advertising agencies, television stations, newspapers, if they're providing design services or professional talent services, or if you have a radio station that gives a not-for-profit commercial airtime at no charge, magazines, newspapers, any print media that give a not-for-profit advertising in space at no charge, or internet sites even. If you get advertising space on another internet providers, these are ones that you would be looking at as being considered donated media and advertising. So as I mentioned earlier, when you do receive donated media, we may have some additional issues with determining, what's the fair market value. And this is something that is faced with, for all gifts and kinds, is something where you might not have an active market for the particular gift that you have received. Some of the items that the not-for-profit has received are also ones that same not-for-profit might not otherwise be purchasing or selling. So they really may not know how to value these. And the other thing that creates a unique measurement challenge for the gifts and kinds is that these are not always used at their highest and best use by the not-for-profit. Typically, there is some sort of future economic benefit or service potential with contributed property. And then you get down to the cash and the marketable securities. These ones are easy and straightforward to value. But for the non-financial assets, if you get food, if you get supplies, clothing, household goods, any intangibles, the process is less clear for determining that value. So what are some of the valuation methods that we could use? We talked very briefly on them, but just go in a little bit more detail here. We could be looking at the cost or the selling price. This could be an appropriate measure when the purchase or the sale was close to the contribution date. In our earlier example, we had the company that was collecting the school supplies. If those school supplies are being collected in the same year that they're being distributed out, that's something where it's pretty easy to value those items, to look at, we're doing our drive in late July, early August, and we're giving everything out in mid-August. It's pretty close time frame. That original transaction to purchase the items would have been done at arm's length. And if there's really no change in market value, they'll want to retain a copy of that sales document as support for the fair market value. Another method that could be used is the sale of comparable properties. This is something where if there is no market of comparable goods, well, nope, sorry, there is no identical item that is out there that's being sold, but there does have to be a market for comparable goods. In the original transaction, maybe that wasn't at arm's length. So maybe it's a portion of land that was being donated. This would be appropriate to look at this to say, we don't have this exact same piece of land that's being sold, but we do have similar land that's being sold. Make sure too in this situation that you are retaining support for the sale of the comparable properties as support for that fair value measurement. Another place that you could look is the replacement cost. So what would be the cost to replace the asset? This could be adjusted for depreciation as reasonable, and it's not necessarily applicable since it would be needed to be adjusted to fair market value. The other place you could look for determining a valuation of the asset would be to look to an appraisal. An appraisal, this might be a good option for transactions where management believes it's a material transaction and it may be the best way to obtain the value for items such as art, real estate, or other unique properties. You want to make sure that the method that you use, that it does fit what works best for you, and to also keep any documentation for that particular appraisal. And really determining the level of valuation method and the amount of effort you're going to put into it may come down to, what is the end result of that valuation. If you have a private foundation that maybe receives some land or other investment property that it's using to determine their minimum distribution amount, they may want to spend a little more time and effort to be able to get a closer appraisal of what the value is of that, because if they're failing to meet that minimum requirement, they may have some additional penalties associated with that. So do watch and look and see, kind of how easy is it to determine the value of these items. What's the most appropriate valuation based on the item that was donated, and are there additional steps that need to be taken to rely on to pull in the experts? So let's talk a little bit about donor reporting here. First off, we'll go back to the basics here. Why does the donor reporting matter? We're really looking at gifts that you're accepting. You're needing to look over that donation to make sure that you understand what's required for that piece. And we talked about that earlier, to really kind of look at, are there restrictions in place? Do we need to track these restrictions? Do we have additional reporting that's required for these based on the donor restriction? What's our risk from a nonprofit organization? If you're not tracking, you're not following up with your donors, you're not really reaching out to others, it is something that within the donor world, if a donor feels that they were not treated properly, they may talk with other donors. So you do have a reputational risk here as well. Your Form 990 reporting, there may be some additional reporting that's required on the Form 990 for certain types of donations that you receive. So what are some of the reports that you might see? Donor reports, these are ones that typically report how those gifts are used. What are the projected outcomes from these gifts? How does that gift fulfill the organization and the donor's purpose and goals? We also have some stakeholder reports. So these are ones that maybe are being used internally or externally, but if your board of directors wants to know, or your development individuals are looking at creating reports, where are these donations coming from? Is it something where it's a restricted donation? Has there been any significant increases or decreases in the donor base or amount? This is something where those stakeholders may want to know that information and have easy access to a report showing that information so that they know where they may see budget shortfalls. They know what they need to be reaching out to. Is a program operating the way that it should be based on the donation support for it? Or is it something where that needs to be changed? And then impact reports. These can be very helpful in providing a personalized communication back to your donor. They also highlight the impact and the use of the donor's gifts. And you can use these to show how transformative that gift has been for the recipient. So substantiation requirements. The IRS does have specific requirements for what needs to be reported. And I did put some information on this slide here for you guys for reference for the publications, where it's coming from, and the IRS forms that are involved. Really, we're looking at, publication 1771. This is something where donors are making contributions to charities. If there's a donation of more than $250 or more, and the donor fails to obtain support for that donation, that's a donation that could be disallowed on their tax return. And so you're really going to want to be familiar with those requirements coming through from publication 1771, and we'll go through it in more detail as to what needs to be included in that publication. The other piece that this publication covers that's very important is when you are providing goods or services in exchange for a donor who's making a contribution. And so this is something where you might have a golf outing or a gala, and the donor is paying $100 to participate in the gala or golf outing, whatever that is. And part of it is that they're receiving the goods or services. So they're receiving dinner and entertainment at the gala, or they're receiving a round of golf at the golf outing. Since that contribution is more than $75, there is some additional reporting that we'll get into in a little bit regarding that type of a transaction. We also have the IRS Form 8283, which would need to be completed by individuals, partnerships, corporations, if they have non-cash contributions over $500. Additionally, there may be a donee acknowledgement that you would be asked to sign on page 2 if the donation is over $5,000. And there is an additional Form 8283. The additional sections on Form 8283, you really should not be completing those. So if a donor is bringing it to you and they have they're asking you to sign as a donee acknowledgement, right above that is a qualified appraiser section. Unless you're a qualified appraiser, there's no reason for you to be signing or doing anything in that section. And it really opens up the recipient organization to additional risk if you are putting information in that section. So really keep your information as the charity to say, yep, we did receive this gift, and acknowledge that section on page 2. If you sell a gift within 3 years, you may have a Form 8282 that's used to report back to the IRS to let them know that that property has been sold. And then there's also an additional publication 4302, and this is looking at the receipt of a donated vehicle. So some information that this will cover is what the vehicle would be used for and that written acknowledgement piece. So going a little bit into more detail on this, we're going to talk on the donated vehicle first. There is that Form 1098C. This must be filed for each contribution of a qualified vehicle that has a claimed value of $500, of more than $500, and it needs to be given out within 30 days of the date of the contribution, unless the charity is intending to sell the vehicle at market values. So that written acknowledgement has to be provided to the donor within 30 days of the date of the vehicle's sale, if it is being sold. And that doesn't mean that if the charity sold, that doesn't necessarily mean that they have to sell the vehicle in the same year that they received it. So if you receive a donated vehicle in December and then sell the vehicle in January, the acknowledgement is actually due by February of year 2, not in that initial year. The reporting is also due to the IRS by February 28th of the following year, and there may be penalties for failing to comply with this requirement. And the penalties typically are assessed at the greater of either the gross proceeds from the sale of the product at the highest, and they're assessed at the highest tax rate, or at the sale price as stated on the acknowledgement. So if the acknowledgement is not based on gross proceeds, really then the penalty winds up being based on the greater of either $5,000 or the claimed value of the vehicle times that highest tax rate. So can get to be quite spendy if you do not timely comply with these, or timely or fail to comply with these requirements. We talked briefly on the donor substantiation rules. There are 6 of them that I listed out here. Make sure that you are giving those receipts back to your donors to acknowledge that you did receive the contribution. You're using your name, the amount of the contribution, any description. If it's a non-cash contribution, include a description of it, but do not include the value. This is an area where you can open your organization up to unnecessary risk if you are providing values. So we recommend only providing a description of that non-cash contribution, and include a statement that no goods or services were provided if that's the case. Or if that's not the case, you do have to provide a good faith estimate of the value of the goods or services that are provided in return for the contribution. Or the other statement that could be provided is a statement that goods or services that were provided by the organization consisted entirely of intangible religious benefits. So really those first 3 requirements you do have to have. And then of the bottom 3, pick the one that best fits the facts and circumstances of the donation. A donor, and the reason this is important is that a donor cannot claim a tax deduction for any single contribution of $250 or more unless they have this contemporaneous written acknowledgement of receipt of the contribution from the recipient organization when they're filing their tax return. I included some examples for you guys regarding these written acknowledgements. So go through, read them, compare them to what you have, compare them to the information that was on the previous slide, and make sure that what you have that you're giving out to your donors does meet this requirement. The IRS has been going through and disallowing contributions for donors when these conditions are not met. And they'll disallow them even for lesser pieces. So if any one of these pieces is missing, if you have the top 3 but not one of those statements regarding goods or services, then the IRS has been disallowing those types of contributions. So watch and make sure, very important, that if you have a donor that's wanting to take a charitable deduction, that you meet these requirements for them so that they do not run into additional issues. We talked earlier, I talked with you about quid pro quo donations, and this was a situation where we had a $75 or more payment. Actually, sorry, let me run that backwards here a little bit. Payment exceeding $75. So you do have to have written disclosure if you have a payment that's more than $75 that is being made for partially a receipt of goods or services and partially as a contribution. This written disclosure must inform the donor that the amount of the contribution is limited to the excess of the contribution over the value of the goods or services that are being provided by the organization. You need to provide the donors with a good faith estimate of the fair value of the market value of the goods or services that are provided by the organization. And this is one where there are penalties. So if you as an organization receive a payment over $75 and it's partially for contribution, partially for goods or services, you do have a significant amount of risk regarding those quid pro quo donations if you do not comply with this. And those penalties are imposed on charities that don't meet those written disclosure requirements. It's $10 per contribution, not to exceed $5,000 per fundraising event or mailing. And it's good to know that this does come down to really that the intent behind this that the IRS is looking at is that those contribution deductions are limited to the extent that the contribution exceeds the fair market value of the goods or services that the donor received in return for the contributions, and therefore the donors need to know the value of those goods or services in order to know what they can use as that contribution deduction. So that's what we have. We hope you learned quite a bit in this call. We do have, the slides are available, I believe in the chat, there's a link that you can go through and look in the Q&A, pull that open and take a look at that. I do have an additional question here asking, so is an organization required to provide a tax receipt automatically or only when requested by the donor? So with the $75, the more than $75 transactions, quid pro quo transactions, those ones the charity is required to provide that receipt to the donor. The other side of it, if you have a purely contribution piece, it is the donor needs to obtain a receipt in order to take that charitable contribution. So the answer to your question is it really comes down to what is your donor relationship? Is it something where you want to provide that receipt to them right away? Best practice is probably to go in and give them their receipts at the end of the year to let them know, hey, here's the value of the donations that you gave to us throughout the year. That way they have substantiation right away. The risk with waiting for a donor to request it is that if the donor forgets, or if something happens and the donor doesn't timely request it, you really run into a situation where if the donor does not have that receipt when they're filing their tax return, that charitable contribution is disallowable. So you have risk for some donor relation issues if you fail to provide the receipt and the IRS disallows the donation.
I was also going to say, Anne, a lot of times nonprofits will choose to thank everything because you never know who your next big donor is going to come from, right? You know, somebody might be testing the waters a little bit with a smaller donation. So you really want to evaluate, I think, other than making sure that you're complying with IRS requirements, you also want to evaluate how that affects your donors. And I know that Amy's probably going to pop in here. We're right at 10 o'clock. Which is our time here today. There are a couple more questions we have not answered. We will get to those and send out requests to them. If there's anything that you guys want to follow up on the answers that we did give, I know that there was a couple of questions regarding the rate for the present value. That's kind of an unusual one. So feel free to send me an email. I can't advance. Anne, can you go to the next slide? I think maybe
I can.
has our,
yes.
Information on there. Like she said, you do have one more. Yeah, there we go. You do have that in there. So you go ahead and feel free to send us an email if you have anything else to follow up with, and we'd be happy to respond.